So how do you bet on the entire casino industry without ever having to touch a slot machine or a deck of cards? Well, there's this one company, Gaming and Leisure Properties, or GLPI for short, that has figured out a really fascinating way to do exactly that. You see, instead of actually running the casinos, they own the land and the buildings themselves. It's a brilliant strategy, and we're going to break down just how it all works.
And get this, it looks like their bet is paying off, big time. The company just dropped some record-breaking results. Their CEO, Peter Carlino, basically said their success comes down to a simple formula: buying up new properties and bankrolling major projects. He thinks this is just the start, with even more growth on the horizon for 2026.
And when he says record-breaking, he is not kidding. A really important number for a company like this is something called adjusted funds from operations. Just think of it as the actual cash profit they're making. In the last quarter alone, it shot up by a massive 7.5% compared to last year. Now, for a company this big, that is a huge leap.
All right, so here's the game plan for the next few minutes. We're going to dive into this really unique company. We'll kick things off with their incredible recent performance, and then we'll really unpack their casino landlord business model. After that, we'll see how they're fueling all this growth, what their big bets are for 2026, and finally, we have to ask the big question: what are the risks here?
First up, those record-breaking numbers. You know, it's one thing to hear the phrase record quarter, but what does that actually look like when you get down to the brass tacks?
What's so telling here is the consistency. It's not just one metric that's looking good, it's everything. Revenue is climbing nice and steady, but just look at that bottom line. Net income, it exploded, up over 23%. This wasn't just a good quarter for them, it was an incredibly profitable one. And that tells you this is a business that's running like a well-oiled machine.
So how in the world are they pulling this off? Well, that brings us to their core business model, which is really the secret sauce here. How can you be so involved in the casino world without operating a single poker table?
The answer starts with three little letters: REIT. GLPI is a real estate investment trust. To put it simply, they're a real estate company, but they specialize in a very, very specific type of property: these massive, high-end casinos. And this right here, this says it all. They don't have to worry about managing the slot machines, the fancy restaurants, or the hotel rooms. Nope, they simply own the physical building and the land it sits on. They are the landlord, and they just collect rent from the big-name companies that actually run the casinos.
Now, the real key to their whole model is how they set up their rental agreements. They use something called a triple net lease, which is basically the dream deal for any landlord. So GLPI owns the place. A tenant like Penn or Bally's runs the show. And here's the kicker: that tenant doesn't just pay rent, they also have to cover all the property's operating expenses. We're talking maintenance, insurance, and the property taxes.
Just imagine a huge, beautiful property like this one, the Hollywood Casino. Under this model, GLPI just sits back and collects a super predictable, steady rent check every single month, while the operator, the one who actually knows the gaming business inside and out, handles all the messy, variable day-to-day costs.
So how well has this whole landlord thing worked out for them? This number says it all. That is the number of times a tenant has missed a rent payment since GLPI was created: 0. That kind of track record just speaks volumes about how stable and successful their strategy really is.
But hey, a stable rent check is one thing, but growth is a whole other animal. A really smart landlord doesn't just sit back and collect rent. They're always looking to expand their empire. So let's check out GLPI's growth engine.
GLP's growth playbook is actually pretty simple, and it has two main moves. First, they go out and buy existing casino properties, which adds new rent-paying tenants to their list. And second, and this is so important, they basically act like a bank for their current tenants, providing the huge sums of cash needed for big expansions and brand new casino projects.
And they are not playing small ball here. I mean, look at these recent deals. They're putting up nearly $1 billion for a new Bally's in Chicago and almost $500 million for a casino in Virginia. The number to watch here is the cap rate. Just think of it as the annual return they get on their investment, kind of like an interest rate. And with rates around 8%, these are some seriously profitable long-term deals.
And all these individual deals add up to a truly massive portfolio. From the super sleek M Resort in Vegas to the beautiful River City Casino in St. Louis, GLPI now owns 69 top-tier gaming properties in 20 different states. That actually makes them the most geographically diversified owner of gaming properties in the entire country.
All of this action has them set up for a really busy future. So let's turn the page and see what's next, and how they're placing their bets for 2026. This is the number to watch. $2.6 billion. That's the total amount of money that GLPI has already committed to funding for future development projects. This isn't just a hopeful guess. This is a pipeline of deals that are already in motion, and it's what's going to fuel their growth for years to come.
And here's exactly how that pipeline should translate to their bottom line. Now, this isn't just some analyst's guess. This is the company's own official forecast. They're expecting their cash flow to grow by roughly $100 million in a single year. That's the direct result of the deals they've already locked in. It shows a really clear, predictable path to more growth.
Okay, so we've got a record quarter, a super powerful business model, and a massive growth pipeline. I mean, it all sounds pretty fantastic. But in any investment story, it is so crucial to read the fine print and really understand the potential risks.
So it begs the question, right? With a model this strong, is it a sure thing? What could possibly go wrong?
Well, the company is actually very clear about the potential headwinds. The single biggest risk is simple. GLPI's success is ultimately tied to the financial health of its tenants. If people stop going to casinos because of a bad economy, that's going to hurt operators like Bally's and Penn, which in turn creates risk for their landlord. Plus, huge construction projects, like that one in Chicago, can always face delays. And of course, things like new government regulations or just the simple challenge of finding the next great deal can always be hurdles.
So it really boils down to two different ways of looking at this. The bull case is that you have an incredibly stable landlord with a diverse portfolio of amazing properties, a proven low-risk business model, and a $2.6 billion growth plan that's already locked and loaded. The bear case, though, is that their fate is still connected to the ups and downs of the gaming industry and the wider economy, with some very specific risks tied to those big construction projects.
And it all leaves us with this one fascinating final question. We've all heard that old saying, right? That in a casino, the house always wins. But what GLPI has built here is a model that really makes you wonder, in the long run, does the landlord of the house actually win even more?